News flow may not be at full throttle in the holiday-shortened week that follows Easter, but investors will still have plenty of material to study all the same. One macroeconomic item worthy of note should be the latest consumer confidence survey here in the UK, provided by consultants GfK. This will cover the month of March, before higher energy, council tax and broadband bills kicked in for many of us, but the study may well still see the impact of rising fuel and food prices as inflation continues to gallop away. We can see the impact of rising inflation on one economic indicator, the misery index, cheerful thing that it is, a construct created by the economist Arthur Okun. It just adds together the unemployment rate to the inflation rate, the two things that can cause greatest economic difficulty. The jobless rate is close to modern-day lows, so inflation is the reason that the misery index is rising, with inflation standing at multi-decade highs. Inflation's taking its toll because price rises are outstripping wage growth. That's already hitting consumer confidence. The result from the GfK survey has plunged from -7 last July, as the country began to emerge from a latest set of lockdowns, to -31 in February, the lowest reading since November 2020. Inflation may not be the only villain of the piece here, given the rising number of Omicron variant COVID cases and the Russian invasion of Ukraine. But inflation and its effect on real-term wages and standards of living and real-term spending could be a major factor. This will be a concern for retailers, especially those of big-ticket items. If confidence sags, so could spending on more discretionary items. Now, in terms of company news, around half a dozen FTSE 100 firms are scheduled to release trading updates in the coming week, and a smattering of mid and small cap firms are due to do the same. Names which may be worthy of further research include the following, although do note that some of these dates could yet be subject to change. Rio Tinto on Tuesday the 19th of April, Bunzl, Hunting and Centamin on the 20th, Relics, Rentokil Initial, Meggitt, Foxtons and Churchill China on the 21st, and small cap currency manager Record rounds out the week on Friday the 22nd of April. But the company which could just cause the biggest fuss in the week ahead is Antofagasta. The copper miner set to release a first quarter trading update on Wednesday the 20th of April. Antofagasta shares are up by more than a third in the past 2 months. Copper's up by just 5%, but the metal is up by around a sixth over the past year. Now, Russia's not a major copper provider, but many investors are looking toward raw materials as a possible haven from the ravages of inflation, not least because central banks can't print commodities and they can print money. As I sit here, copper's trading around 10% below its all-time high of $11,300 a tonne reached last autumn. Usually, a firm copper price would be seen as a good sign for the health of the global economy, because the metal's malleability, conductivity and ductility mean it's got many industrial uses across infrastructure, construction, cars, electrical equipment, to name but 4. It's not for nothing, it's got the nickname Dr. Copper. In terms of Antofagasta more specifically, shareholders will home in on 3 sets of figures. The first is output. Alongside February's full year results for 2021, Antofagasta gave guidance for 2022. The Chilean firm suggested that output this year would drop by around 6% at the midpoint of guidance, and that's for copper production of 660 to 690,000 tonnes. That compares to 721,000 in 2021. Lower grades at the Centinela mine and lower output at the Los Palambres site owing to drought are key factors there. Second key number is costs. In 2021, net cash costs rose 5% to $1.20 a pound, owing to movements in the Chilean peso and higher energy and fuel costs. Further increases look likely in 2022, and a big jump to $1.55 per pound is management's current expectation. That's the equivalent of around $3,400 a tonne in metric terms, by the way. The third figure is capital expenditure. Antofagasta spent $1.8 billion in 2021, and it currently expects something similar for 2022, given its forecast range of 1.7 to 1.9 billion. All 3 of those will shape profits and cash flow, and any change in guidance for any of them could lead to changes in analyst forecasts for earnings and dividends. At the moment, the consensus forecast for Antofagasta's profits is for them to drop by just over 10% this year to $4.2 billion based on the company's preferred metric of earnings before interest, tax, depreciation and amortization, or EBITDA for short. The dividend, meanwhile, is expected to come in at 95 US cents a share, down from $1.42 in 2021, owing to that mix of lower output and higher costs, though it's unlikely that management will comment on dividends at this early stage in the year. Finally, analysts and investors will look to management for any comment on the political situation in Chile. Santiago's government, led by President Gabriel Boric, a former student activist, has begun to discuss nationalisation of key copper, lithium, and gold assets, or at least new, higher mining royalty payments. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for watching, and I look forward to seeing you again next week.